to Nirmal Bang, ladies and gentlemen. I'm Hiral. We have with us Radhika Rao, Senior Economist, Executive Director at DBS Bank, joining in. Welcome to the show, Radhika, and always a pleasure to speak to you and get insights from you as well. Radhika, let's first start with the latest information that we've got on the economic front with regards to where the CPI inflation goes. The number came in at 6.95%, which was overall higher than what the consensus estimates were as well. What's your view?
Thanks, Cyril. Thanks for reaching out. So certainly, I think inflation being higher is something that is a theme that's playing out globally as well as for us domestically. We should remember that inflation was high even before the pandemic, and it has been high through the pandemic of various reasons, right? The many various idiosyncratic factors as well as what's happening globally. But the latest bout, I think, is increasingly becoming, imported price pressures. You start off the question with the March CPI inflation. In March, in particular, I think it was more to do with food. In fact, our own analysis is that food. It's already a heavy weight. It makes up close to half of the basket, but in fact, it punched above its weight in March. It made up almost for 80% of the increase in inflation, and certainly, to your point, it was above consensus. So what that does, and that is, even before your what's happening globally is beginning to reflect. So what that suggests is going forward, you're going to have more non-food components that's going to add to the price pressures. Namely, you've got fuel prices that have been incrementally raised since late March. Then you've got CNG, LPG prices that have also been increased, and again, these price pressures then impacting manufacturers and service providers, and then going on to adjust their own prices higher as well. And certainly these kind of fuel prices in essence usually has a number of second round effects, and also tends to get a bit more generalized because it feeds into logistics and it feeds into transportation as well. So we are talking about inflation now being, at least for the next month or so, being above close to about 7%. That's way higher than where the inflation target range is. We are above 4%, and we are well above the upper end of the target ranges as well. So essentially, it raises the trend, overall for inflation. So that has also pushed us to revise our own inflation target, inflation average for fiscal 23 to about 6.4%. Again, on that means that all 4 quarters in fiscal 23, we see inflation averaging above 6%.
Right. So with all of this, another aspect over there is, everyone was concentrating on rural growth. That will be something which will hold fort versus urban growth. Simultaneously, if you see the inflation, fine print, rural grow area inflation has risen for March, which is clearly suggesting that there is somewhat of pressure on rural consumption. However, urban inflation has been slightly muted as compared to that. How would you read this scenario in terms of inflation versus growth between the two then?
Uh, Certainly, I mean, when you have rural inflation predominantly led by food, it can be also interpreted as better, returns of food prices generally being higher. And then I think you've got, fertilizer, so input prices for agriculture. So inflation is one aspect. The other aspect is also that agri inputs, particularly from the fertilizer front that's happening again globally, is also feeding through. It's going to feed through locally as well. Now that's going to have a negative impact, but that can be possibly offset by government policies by way of higher minimum support prices or by higher subsidies as well. So net, I think there is certainly a need for higher food prices to translate into higher rural incomes. And we should remember that rural is not entirely farm incomes, right? 2/3 of the output now is non-farm. So essentially you need, and which basically has backward linkages to how urban India is also performing, right? In terms of manufacturing, in terms of MSME performance. So overall, for rural sector to regain health, I think we can get some support from what's happening on the food prices, but otherwise you need also fiscal policies to help prop up demand broadly. And again, if urban part of the sector is not doing too well, so I think we can't expect rural to do extremely well either because of strong backward linkages. So that was how I would interpret overall rural direction. And certainly inflation being higher tends to hurt the terms of trade for the rural households as well.
Right. So post, both these readings, are you seeing an upside risk to the CPI inflation forecast? I know you mentioned, what you're targeting, but do you see an upside risk?
Certainly. You see, I think there are many moving parts at this point, right? We are in a sense, taking a call on how oil will be on average for the next 12 months. And the past 3, 4 weeks has told you that oil can go from 120 plus to below 100, and then it can trace back higher all the way, which is at about more than 110 at this point. So it is extremely fluid. So that's why we are working with base case in terms of how the oil prices would average in the year forward. So based on our oil analysts' assumptions, if we take oil to be in the vicinity of about 95 to 100, then we see inflation, at the figure that we see, which is at about 6.4%. But if you see inflation average even higher, that's about 120, 130, then of course you're looking at more than 6.5, 6.6%, kind of inflation average. Again, like I mentioned, it's just not crude prices; it's what happens to its trickle down effect. And this is coming at a time when reopening in general is also catching momentum, right? You've got demand indicators that are doing better, and all of that can actually be a very unfortunate mix insofar as price pressures are concerned. And if you see inflationary expectations, the recent survey, while for the current reading it's pulled back, but 3 month and 1 year forward, 1 year ahead has ticked up. So inflation expectations, in a sense, are hardening. So I would think at this point, yes, there are upside risks to our number, but again, there are many moving parts, and I think a big assumption that's underpinning, ours as well as perhaps the market's expectations of what's happening on crude prices. So if that does, I mean, we don't see it that it's very likely, but if it does correct very sharply, I think that will be a great development. But looking at how things are stacked up, it does look rather difficult for it to correct all the way.
Right. So with all of this, currently a possibility of 50 basis point rate hike in FY23 is what the market was really pricing in. And now a lot of possibilities of a 75 basis point rate hike in FY23 is what everyone is looking at. What's your expectation on that, firstly? And secondly, do you think that we will not really see aggressive rate hikes as growth concerns would then linger?
Certainly. So we are a bit higher than where the consensus is, as you mentioned. We expect about 100 basis points increase in fiscal 23. And I think this is a function of two things. Of course, I mean, markets were praying for or hoping to see the central bank begin to normalize policy. So that kind of fed through in the March meeting. I think on several fronts, it was amply clear that while growth remains a concern for the RBI Monetary Policy Committee, inflation is equally a big watch point. Not, I wouldn't say equally, but much more a watch point. And I think that was in a way reinforced by what happened to the March inflation rate, which came good 60, 70 basis points higher than where the consensus was. So these two factors, to our mind, kind of convinces the central bank as well that inflation is going to be higher than, their revised forecasts as well. It also means that inflation is going to be above target, like we discussed earlier. That means the central bank will also have to, it kind of, test their own legislative mandate of inflation targeting. So for 3 quarters or successively 3 quarters, and that's going to happen as well. So I think that all of those factors are playing on their minds, and that's why we think that have set the base for rate hikes to begin. So while we were expecting sequence, which is essentially June flag off and August rate hike, we've essentially combined that into one, which means that the shift in stance and rate hike could happen as early as the June meeting. Then we see two more happening by end calendar year 22 and one in the March quarter next year. So that would, essentially bring us to about 100 basis points within this year. I wouldn't call that extremely aggressive, especially if you compare with what's happening globally. We see US rates, in fact, going to almost 3% and above by midpoint of next year. So that's a good 200, 250 basis points higher than current levels, by which, India's hike cycle to our, again, according to our forecast, is not as aggressive, but it is required because inflation at this point, you need to have inflationary expectations that need to be kept in check. to prevent a generalization in expectations. Uh, but I think they're mindful of growth, so I don't see the risk that it's going to be overtly aggressive. But nonetheless, you need to get out of that pandemic-driven rate cutting cycle that we had entered into, right? So in some way, we'll be returning to where we were 2 years prior. So I wouldn't think that would be extremely aggressive, given the kind of inflation dynamics we have at this point.
Right. And with all of this, do you think the bond yields are likely to see some more upside? And if there is any spike, it could likely be met with RBI intervention of some sorts?
Certainly, I think you can see it's kind of a dichotomy in what's happening with the rupee and what's happening with the bond yields. The rupee is relatively stable. Again, the IPO, the national insurers IPO expectations have come back, meaning the flows might be positive for the currency. But on the bond yield funds, you certainly see bond yield side, you certainly see the pressure. I think Jan to March, it was it was gaining, yields were ticking up, but not as much. Essentially because you had auctions that didn't happen, and there was that supply demand mix was a bit better. But going into fiscal 23, I think it's going to be adverse, right? Because you've got supply, which is, again, if they do stick to the gross supply that's been mentioned, we see it could be a bit lower, but nonetheless, if you assume it's going to be that high, and 60% of that is going to be front loaded the first half of the year, and you don't have visibility on very strong demand side catalysts, then I think unfortunately it all falls on the central bank's shoulders. So while in the March meeting the RBI mentioned, the April meeting, they did mention that they will step in when required and as required. We do see them taking a more decisive role. And then banks have also been given additional dispensation, so that would mean that banks' demand will also come by. The incremental increase, the only big question mark here is how the foreign investors will participate, and at this point it looks rather lukewarm. And we haven't got any particular guidance on the global bond index inclusion as well. That means the delta on foreign investors might not be that big. That essentially leaves the central bank to purchase perhaps 2.5 trillion or lakh crores of government bonds, which is essentially that would put it, as the central bank as a rather important participant in the borrowing program. So that seems to be the dynamics in the first half of the fiscal year, and that's why we have yield expectations or forecasts going up to 7.4, 7.5% at this point.
Right. And overall, with all of this said and done, what is your projection with regards to growth?
Uh, Certainly, we did start off the year, that's the calendar year 22, expecting certain catalysts to fall into place, basis of which we had a 7.5% growth forecast for fiscal 23. We are maintaining that for now, but I think there are downside risks creeping up, mainly because again, this goes back to the consumption part being not as strong. At the same time, you have rising inflationary pressures, which basically comes back to hurt consumption again. And concurrently, we should remember that the pandemic was the talking point at the start of the year. We're not talking about it anymore, but that has created a scarring impact on labor markets, which we have not got past as yet. So that being a medium term issue, plus this additional pressure on purchasing power, suggests that we see a bit of downside risk to our own growth forecast of it could slip towards 7 or a bit below 7% at this point. While consumption is going to be weaker, the other thing we are counting on is that public sector capex remains high. Budget did outline for it, and that hopefully will attract private sector players as well, who are in a much better health, particularly the formal sector, in a much better health than they were pre-pandemic, especially in terms of being deleveraged, and all of that. So these two plus the external sector strength, these are three things that we are counting on for growth in fiscal 23. But at this point, we have, like I mentioned, downside risks to our 7.5% growth forecast, which I think will be closer to 7 or a bit below.
Right. And overall, what's the view that you have with regards to the current account deficit as well? Because clearly, if you see in terms of the borrowing, What the government has actually looked at for the first half of FY23 is around 8.45 trillion, or almost 59% of the budget. How do you see that panning out along with the view on the fiscal deficit?
Sure. So the question did have quite a few, sub points. So I'll just start off with the current account first and come to the fiscal bit thereafter. So on the current account front, um, we had a stellar fiscal 22, right? So exports did top that elusive 400 billion. In fact, we were at 420 billion, so which is a new record high for exports. That was a great year for the external sector. But unfortunately, at the same time, we also had imports tick up because of a higher commodity bill, as well as some part of non-oil, non-gold also heading higher. So net we had a much wider trade deficit, and that left the current account deficit as well wider. Fiscal 23, I think that dynamics is going to continue. We do count on exports being faring well, in the course of this year. Again, partly because of price effects, partly volume effects as well. But imports is a bigger worry for us because of a wider commodity cycle. And we shouldn't just talk about oil, right? Oil is, of course, a big part of the story. One third of our imports are oil. But you should talk about the other commodities as well. Many other commodity groups have risen concurrently. A lot of that we import as well. So that means, again, we're going to have a wider import bill. Net, where does that leave us? Even though we have strong assumptions on FDI, portfolio inflows, and all of that, we think current account deficit is going to be in the 2.7 to 2.8% of GDP kind of levels, which is, of course, quite wide as compared to where we were last year or the year before as well. Still manageable because on the funding side we expect FDI to be stronger, portfolio inflows not so much, but at least FDIs will give us that cushion. But balance of payments would slip into red, after 2-3 years of strong surpluses. So that will be the dynamic on the current account front to our mind. And if you talk about the fiscal side, I think fiscal to us looks relatively better, to mean that the kind of targets that have been set, I think it can, the math can stay within it. There is a cushion, significant cushion in terms of the growth forecast assumption, which is quite conservative. Even the revenue assumptions are quite conservative. The divestment one, which we always point out, that is also quite conservative at this point. So I think there is room for upside on revenues as well as on the growth front, which will kind of give a cushion to what's happening on expenditure, where the subsidies, particularly on fertilizers, might go up, food might also go up, and excise duties at some point might need to be cut, because passing on all of the what's happening globally, it's going to be quite difficult on real purchasing power on the ground. So even if we assume that there are going to be higher outlays, higher expenditure outlays, we do think there's enough cushion in the math to keep the deficit, in fact, a bit below where the government's targets are. So I would think that, relatively speaking, fiscal deficit is likely to stick to target, but current account might be wider. And tying that back to your bond yield question, if even if the math stays, the borrowing number is still quite significant, which means that yields will certainly face some upside pressure. Short end because of what's happening on the rate front, and the long end much more to do with the fiscal.
Right. So, Radhika, with all of this said and done, anything that one should be monitoring from here on over the next 6 to 12 months?
Oh, yeah. I mean, quite a few. I would think exogenous factors are certainly one where very not everyone has an handle. Unfortunately, so, because we've got multiple headwinds. We've got Fed, which is tightening faster and more aggressively. You've got China, which is likely to slow down because of what's happening on the COVID strategy front, and which it doesn't have a clear end in mind. On the horizon, for that matter. And thirdly, of course, is what's happening on the geopolitical front, right, which is pushing up commodity prices, and also some amount of sentiment compression as well. So exogenous, we would certainly watch out for all these three. I think the path ahead, one can make assumptions for the year ahead, but a year ahead is a long time. So things could change quite drastically for the worse or for the better. So we would keep track of that, and locally, certainly the inflation angle, and to our own expectations on how growth will do. I would think overall policies will still be supportive. We expect the RBI to tighten, but not too aggressively, which means it would be we were looking at real rates coming back to neutral rather than being in the positive. And on the inflation on the growth front, of course, hoping for consumption to stabilize. So that could come partly again because a lot of the measures now are supply driven. You've got the PLI scheme that's taking effect, manufacturing activity picking up for as a medium term target. Sectorally, you're seeing a lot of bright spots. You've seen new economy companies doing well. You've seen pharma companies doing well. You've seen electronics foothold as also being increased, more FDI coming in. So those are positives, but for all of that to convert into real growth on the ground takes time. So we would watch out for those developments as well. So exogenous, certainly, I think that's the larger unknown. But domestically, I would think consumption as well as investment activities and progress on that. Certainly, many bright pockets, but that to become broad-based is something we would look at very closely because that is as a necessary precondition, we think, for private sector capex as well to kickstart.
Absolutely. There are so many moving parts right now post COVID as well that I think to take a real view gets sometimes gets really difficult. But let's hope for the best. Thank you, Radhika, so much for joining us on the show. Always a pleasure to speak to you and get insights. Thank you. Stay safe and speak to you soon again.
Thank you very much, Cheryl. Thanks to your team.
Subscribe to our YouTube channel for in depth interviews of India Inc. and press the bell icon so that you do not miss our updates.